Here, stock was starting off the year up around 235, and it has been coming off. We spent a fair amount of time kind of balancing throughout January, February into March before we broke down, and then bottoming out around 173. Now, Don's got a significance associated with, but hey, easily identifiable trend to the downside. We expect continuation more likely than change, and that's why they say the trend's your friend, right? Those that have been shorting this have been able to let the market kind of do the work for them. Those that have been long this ultimately have, well, on a short-term basis, have had to kind of move very quickly and position themselves properly. On a long-term basis, you've been struggling. But take a look here. This is a pretty good reflection of what we're seeing here. A market that's coming under pressure off recent highs. Again, the highs from the end of last year up around 267, but also a market that's held key lows here around 175 here. So take those out right now, and yeah, you'd be opening up doors for some further energy to the downside here. Stock that has been, continues to be under pressure here, Nicole, below the 50-day and below the 200-day moving average.
Yeah, so trend is your friend. I mean, there's so many folks who are pulling for Boeing, a great American company, national security, et cetera, but you do see the downside potential. Final thoughts there, and then we'll get to your next one, Don.
Yeah, look, the corporate reshuffle, it's going to happen in here, but the company's problems are still literally ahead of it, and as such, still bearish here in the near term.
All right. Then up next is the VIX, the fear index. What are you watching there?
All right, so in the VIX, what I'm actually watching right now is volatility, what looks like it's being suppressed. We're still seeing a tremendous number of premium sellers rushing into the marketplace on a day-to-day basis. Everything from what we term zero DTE, okay, out a little bit further. And it looks like, again, volatility is being suppressed right now, ultimately by option premium sellers. As such, again, volatility right now in the overall marketplace is relatively low, but there's some, again, rumblings of some tech issues right now, and those may actually bleed through to some higher volatility in the marketplace. I think it's an appropriate time to take a bullish position inside of VIX. So that would mean if volatility does emerge, if volatility goes up, this trade would actually profit. Now, you can use this trade as a standalone, or you can use this trade as a hedge. This is a May 22nd trade. We are buying the 14 calls, selling the 19 calls. So it's just a $5 wide, again, a $5 wide call spread done for about $1.10 debit, looking for some volatility to emerge in the next couple of weeks, maybe 2 months. And that is exactly the time frame, of course, of this particular position.
Okay. And, you know, and it's true. It's sort of been sitting there. I mean, there were times, there was a great trade. You'd buy it down at 12 or 13, and then you would sell it up at 7 or 18. I mean, people were doing it. That was the best trade ever. It seemed like the easiest trade that people were doing for a while. That being said, it was a couple of years ago. So, Ben, tell us about the chart.
Yeah, I think buying some insurance with the market at all-time highs is never a bad decision in many ways, right? Helps you sleep a little bit more easily at night, and ultimately, if you do see that pullback, you get to have your eggs in not necessarily all in one basket. Now, the VIX, for me, a bit of a difficult beast to tame. The one thing that has me a little bit concerned about looking for some upside movement in the VIX is that oftentimes it's very short-lived, right? So let's take a look at the chart here. You can see a couple spike highs. I've got a few weeks worth of price activity here, and you can see that we were up around 1794, if you remember. That was all the way in the middle of February. You can also see how we've seen a series of lower highs and lower lows come into play. The VIX here right now as we speak, hanging out right around this 13 level. Pretty good reflection of what we've seen in terms of the broader market. Take a step back and a snapshot, a mental image of this picture. again, lower highs coming into play, pretty well-defined trend to the downside as we've come off that near 18 test and again back to this 12-13 level. Here you can see another situation where it kind of feeds into what I was talking about going back to October of last year. If you remember, VIX was up around 2023 when the indices were on those lows that we've rallied off of convincingly. And well, there you can see a reflection of basically the mirror image of the move up we've seen in stocks. Now the VIX kind of sideways more so recently than not, which has me a little bit surprised, right? We've kind of hit the brakes in terms of that downward momentum, yet stocks have continued to rally. Now, one thing I will argue is we have seen gold, which I think has benefited from that more risk or that insurance type buying, potential for a risk-off type environment coming into play here. Gold's definitely enjoying some gains. I think there's a couple reasons behind that move up we've seen in the gold futures. But here's another example here, just adding some time on back to 2020. If you remember the pandemic, look, up around 85. And just want to point to, I like Don's idea, right? Because we are at some point going to see a rejection of these upper levels or correction. I also like the idea of having some time on this one so that you don't necessarily have to time it perfectly. We will see a spike in the VIX. The question is when. Giving it till May ultimately, I think, opens up the door for that potentially to happen here.
Okay, that was a good summation of the VIX today. Final thoughts on this one here as you see this upside potential, Don.
Yeah, as Ben was saying, the VIX tends to be a bit of a fickle beast. You know, low volatility doesn't necessarily constitute that it's going to be high volatility, but I'll give you one other aspect over here that really comes to mind. Option volumes lately have been just horrendously low. Like the daily option volume's been horrendously low, and it's something I actually look at. You know, the S&P volume has also been incredibly low. It indicates there's not necessarily a lot of hedging activity, but those call buyers that have rushed into tech stocks, they have dissipated, and it's one of the other reasons I'm looking at, hey, this could be the forefront of some vol in the next few weeks.
All right. Next up, Disney. By the way, the board meeting about who's going to be on the board that votes next week. I think it's on the 3rd. We'll watch for that. How are you feeling about Disney at 120 today?
Yeah, not loving Disney. I am not loving Disney over here. I am definitely a bear inside of Disney, and it comes on a number of fronts. Look, we can talk about, the politicizing of Disney all you want. Probably needs a little bit of a corporate reshuffle in there as well. Nevertheless, I'm actually looking at the Disney in terms of the 120 level. Let's push aside all of the other fear, all of the other risks in here. Let's push aside even the board. The 120 level creates, I think, huge overhead kind of resistance inside of Disney. It is on a rip to the upside, but it has to crack through that 120. I think it's actually going to pull back and fail off of it. I'm going to give myself some ample time, though, on this one. I'm going to go all the way out to the June 21st, and I'm going to be buying a put spread. Again, June 21st, going to be buying a put spread. I'm going to be buying the 115 puts. I'm going to be selling the 110 puts. This trade is done for a $1.40 debit, looking for an end and a reversal to Disney off of that very specific 120 level.
Okay. So I don't know if I've ever seen a bear at Disney. Just kidding. Ben?
Yeah, kind of un-American, isn't it, Nicole? Let's take a look at the chart here. It's definitely against the trend, that's for sure. Well-defined to the upside across multiple time frames. Let's dive into it here. Take a look here at where we were just a couple days ago, or yesterday, I guess I should say. The stock was trading down around 118, rallied all the way up to 122 here today. And as we look here, Don was talking about some of those tech names coming under pressure. Disney still holding on to positive territory. So I sort of feel like that broader market sell-off that everybody's waiting for and expecting to see at some point, when names like this are in positive territory, it's not necessarily signaling that we're there yet, right? This is more just, I think, jitters, intraday volatility we're seeing as the market kind of siphons its way through these and near these all-time highs. Getting back into this chart here, though, you can see on this, again, 1-minute candle chart, how looks like every dollar the market's kind of paused. Shares of DIS have regained composure. We're kind of testing a lower extreme range we've been in. Don mentioned 120. I've got my eye on that area, that's for sure, Don. 119, 120, 121. It was drawn to say the least here. Let's take a look here. Add a little more time on. That's a 1-minute candle chart, so we don't want to put too much into that. We've now got an hourly candle chart here going all the way back to the lows that we saw around 106. If you remember, That was when we were down at the end of February. 3 areas of consolidation to the upside. Again, kind of teetering around this 120 area. I'll give it to Don. He's got his eye on that a key area to watch here right now. Could be starting to establish a new area of balance at this upper level here. That would be supportive of this trend to the upside. I want to, speaking of trend to the upside, one more chart here I've got for you to show you. This is a longer term, so we're going all the way back now to October of last year. Lows that we bottomed out last fall around 78. Look at this. I mean, talk about it. It's easily identifiable here, and you can also notice how we're in a vertical phase. We're breaking out of balance right now up to 122. Another example of well-defined trend up. Migration of value higher from 82 to current levels. And then again, we are seeking value higher right now. Bulls are hoping for something a little bit more overlapping and rotational around this 120 level. So you could get something that the bulls would be happy with, and Don the bear could be satisfied with here as well, as we see that, Nicole. But it looks to me like, again, longer-term trend remains higher here.
Yeah. All right. Thank you for all of that. Great charts there, Ben Lichtenstein and Don Kaufman. Final word.
Yeah, look for some follow through right now inside of some of the mega market caps, specifically NVIDIA. NVIDIA, as it sees some sell side activity, again, is actually causing what we call statistical arbitrage to actually pull tech in, which is actually pulling down S&Ps to some degree. The only question right now is there going to be follow through? Obviously, this Friday morning when markets are closed, PCE is coming out. I'll tell you what, next week could actually be a really interesting, volatile week for the marketplace.
All right, we'll be ready, and everybody will be back from their spring breaks and such. Don Kaufman, Theo Trade, Ben Lichtenstein on those charts. Thank you both for the big three. Thank you. Coming up next, we're going to spotlight a couple of stock picks for you. Names such as NVIDIA and Apple. Why you should be watching those super closely. Stay tuned.
I was born on the south side of Chicago. It's been a long road, but now I'm working for Schwab. I love to help people understand the world through their lens and invest accordingly. You can call us Christmas Eve at 4 o'clock in the morning. We're gonna always make sure that you have all of the financial tools and support to secure your financial future. That means a lot for my community and for every community.
Every morning, every trade, always live. Expert earnings analysis, in-depth technical insights on every changing trend in markets. Available anytime, anywhere, on any device for free. Welcome to Morning Trade Live on the Schwab Network. I'm Oliver Rennick.
Binge watch the market with the Schwab Network. Tune in 24 hours a day, 7 days a week on schwabnetwork.com and on all of your favorite streaming services. Schwab Network, available anytime, anywhere, on any device for free. Binge watch the market with the Schwab Network.
Get each and every angle, the whole picture. Everything comes full circle on Trading 360. Catch us right here at the New York Stock Exchange on Trading 360, only on Schwab Network.
Download the Schwab Network app and join in on the latest market trends. Available anytime, anywhere, on any device for free. Schwab Network.
Welcome back to Trading 360. I'm Nicole Penelides, live at the New York Stock Exchange. Thanks for being with us. It's a look at developing stories here. Kevin Green is with us, senior markets correspondent, taking a look at some names in the pharmaceutical sector. And Merck has been a winner this year. It's up nearly 20%. And today, some good moves after an approval from the FDA. Tell us a little bit more about the story, Kevin.
Yeah, Nicole, we are seeing the shares up about 3%, and that's after the FDA actually did approve this lung treatment drug here. It's called Winrevair, and this is actually a very big development because this does actually impact around 40,000 patients in the United States. That's the estimate, and this is for pulmonary arterial hypertension, which is a type of high blood pressure that impacts the lungs and the right side of the heart here. Now, this drug is actually being priced at around $14,000 per vial, and right now the treatment regimen right now is for a shot every 3 months or every 3 weeks. So this actually equates to around $242,000 a year just for one patient for the treatment before insurance. So that's where we are seeing this windfall when it comes to the stock price here today. And this is actually a key development after their portfolio of drugs, especially one of their bigger ones called Keytruda, which is a cancer drug, is going to actually lose its exclusivity in 2028. So this does actually help them with their product portfolio. We do actually have Wells Fargo increasing their price target on the stock to $135. That's up from $130, and they keep their equal weight rating on the shares. We also see a similar type of reaction when it comes to Citi, which they also did adjust their price target on the shares at this point in time based on the drug results and the opportunity for gaining market share when it comes to treating this particular disease.
All right, good news there for Merck. Merck shareholders, new highs, as you noted. And then there's Moderna, and it's getting a substantial investment.
Yeah, we are seeing those shares up about 1.6% here, and they're actually going to be receiving $750 million from Blackstone here. And this is in exchange to have royalty and rights to its influenza drug that they are currently working on right now. And this is actually a very unique strategy for Moderna. You could actually look at trying to raise capital through additional equity in the marketplace. You could do that through debt, but they're trying to look at some of these financial companies that might want to have a particular stake in the company in order to reduce the R&D cost here. Now, even though they're having this influx in capital, their R&D expenditures or their forecast moving forward has not actually adjusted, but they are looking once again at new ways to be able to raise capital here. And once again, this is going to be one of those type of situations that could actually change the overall structure of the healthcare industry on how to try to source new capital and how to bring drugs to market. We know that mRNA technology was very influential when it came to COVID-19, and Moderna is actually looking to utilize that for several other different drugs, obviously for influenza, if you're looking for RSV in children, and even Lyme disease and things of that nature. So the product portfolio is still in the works. They haven't brought anything to market to really shock the market, but I think this might be a nice first step for them in order to try to ease some of the concerns from its investors.
Yeah, that certainly sounds great. And also the company announced, I think you may have mentioned this, the mRNA 1283 met the primary endpoints in its phase 3 clinical trial. I see that not too long ago. That's all great news. And we're seeing that Barrows for it as well. Kevin Green, great to see you. Thank you. All right, let's get back to your portfolio. A couple of stock picks that you may want to hone in on. Let's talk to Ken Mahoney, President Mahoney Asset Management, with us here. Thank you for being here today. So before we get to your stock picks, what's the big picture? Because everybody uses NVIDIA almost as a market gauge of which way this market will go day in and day out. How are you feeling about the market overall?
Again, we like it. I think there's enough tailwinds here. You know, the big watershed event was end of October when Fed chair said, hey, no longer higher for longer, but now rate cuts. And he doubled down on that last week. And you look at it, that's 5 months in a row. So you try to figure out what's happening, the Fed. So it's been a lot about the Fed. Then, by the way, the December 31st earnings reports that came out, we saw Meta blowout numbers, Microsoft, NVIDIA, of course, blew out numbers. Again, a month later, how they go off cycle. So again, I think combination of Fed being accommodative, even if they don't cut the way everybody wants them to cut, at least they're not restrictive like they once were. And then we get some good earnings, and March 31st quarter now just ending here this week. 3-4 weeks from now, we hear from the big tech. And most likely, there are going to be a lot of companies that are going to beat and raise guidance, and that gets investors excited like me when they see that.
All right. So that being said, since you do like the market, whether the Fed cuts once or 3 times, or in the meantime, you're still a fan of NVIDIA, right?
Yeah, for a lot of reasons. Look, we hear it's always expensive, and that's if you use like a past PE. But if you look at the future PE trading at 35, for the last 10 years, it's been averaging about 35 forward-looking PE. Why? They have a lot of growth. And what is expensive is not NVIDIA, it's companies like Nike. Nike reported last week They have a future PE of 35, the same as NVIDIA, yet their sales gonna be top line revenue like 1%. NVIDIA with easier comps year over year, we're probably gonna see throughout the rest of the year at least 100% top line. Analysts are still scrambling to kind of catch up with them. And it's not expensive if you look that way. And if you listen to the AI conference last Monday with the CEO and so forth, and again, Blackwell coming out, that's gonna be a great new product line for them. But he said we're probably in the second or third inning of AI. So we're in the second or third inning, Nicole. There's a pretty good runway still continue to make money in the video. Now you may not want to hang out in the ninth inning or extra innings than this,
Sure.
but in the second or third inning, there's still should be good times, should be good earnings. Again, and money flocks towards those companies that can beat estimates and raise guidance.
Yeah. And you also have Microsoft and Apple. Microsoft not too far off of its most recent high, but Apple was at around $200. It's at 172. This may be a controversial pick, or people love it for the long term. Maybe a quick thought on Microsoft, but then your thought on Apple, why people should have this in their portfolio today.
Yeah. Right. So Microsoft has all the verticals, right? Cloud, gaming, Microsoft this, Microsoft that, Microsoft Office. Oh, and by the way, now they're adding their Pilot, which is their AI, and the channel checks are showing a lot of great conversion. So Microsoft, you get all those goodies, all those verticals, and you get upside with AI. Now, Apple is still in a downtrend. We're not really aggressive here. That's why we listed 1, 2, 3. But in June they're going to be coming out and talking about the iPhone 14. It's going to be a winner. Here's your little phone, which is now you kind of hardly even use Siri. You can really start using Siri with the new phones, AI, and it's gonna be like Siri on steroids. There's gonna be a lot of upside, but again, we're gonna have some overhead and some issues because of the Department of Justice this last week slapped them, and again, I think unfairly so. But they're gonna have to muddle through that. But in the second half of this year, you're gonna hear a lot more about Apple's strategy with AI, how users gonna have a huge upgrade cycle, we believe, with the new iPhones that are gonna make a digital assistant really like a digital assistant.
Yeah, and look, on June 10th, we have the Worldwide Developers Conference, too, so we'll hear, excuse me, more about that at that time. Great to see you so much, Ken Mahoney, Mahoney Asset Management. Coming up, disruptors will be highlighting Western Digital. Evercore ISI has something to say about this one. So does George Sillis, next on Trading 360.
Young lady who was mid-30s, a couple of kids, recently went through a divorce. So she had a lot of questions when she came in. I watched my mother go through being a single mom. At the end of the day, my mom raised 3 children, including myself. And so once the client knew that she was heard, we were able to help her move forward. Your client won't care how much you know until they know how much you care.
Binge watch the market with the Schwab Network. Tune in 24 hours a day, 7 days a week at schwabnetwork.com and on all your favorite streaming services. Schwab Network, available anytime, anywhere, on any device, for free. Schwab Network.
Spotlight the biggest market trends on Trading 360. 11 a.m. Eastern, only on Schwab Network.
Kickstart your morning with a full dose of commodities, technical analysis, economic data, and live reaction in global markets. Available anytime, anywhere, on any device for free. And available on all your favorite streaming services. Futures with Ben Lichtenstein every weekday, 8 a.m. Eastern on the Schwab Network.
Wrap up the trading day with me, Oliver Rennick, for the biggest earnings coverage, 3 p.m. Eastern. It's Market on Close. No place better than the Schwab Network.
Download the Schwab Network app and join in on the latest market trends. Anytime, anywhere, on any device for free. Schwab Network.
Welcome back to Trading 360. It's time for the Disruptors every day. George Sillis is with us, senior markets correspondent, to take a look at our disruptor. Today's name is Western Digital, and Evercore ISI has a note out on Western Dig. We are seeing it down 1.9%. Some of your thoughts on Evercore ISI? Why are they with this coverage today?
Well, I think, Nicole, there's a lot going on, obviously, with artificial intelligence and data centers. And we talk about, of course, the mega caps like NVIDIA and so forth. But there are all these periphery names out there that have been moving also in sympathy with these new technologies, which includes Aristanet, which provides like network solutions and network hardware. But at the same time, like Micron Technologies and even Seagate yesterday, which provides, memory as well as storage solutions. And that's where Western Digital fits this sort of periphery element to artificial intelligence, because they're a major provider globally of memory as well as storage solutions. And there's always been talk about potentially Western Digital also separating the businesses into two. In other words, their memory into one business and their storage hardware as well as their cloud storage division in another business, but that's been ongoing for quite some time. But nonetheless, if you consider what's been happening in the past couple of years relative to the forward estimates, there had been a lot of inventory, especially in the memory, flash memory, as well as storage, and that seems to have manifested into declining sales and earnings on a trailing basis for companies like Seagate and Western Digital. But going forward, things are actually looking rather promising, and I think this is why Evercore has actually initiated coverage at an $80 price target, because if you look at Western Digital's prospects from an earnings standpoint, even though the stock is higher by 93% in the last year, for the full year of 2024, they're still estimated to lose about $1.57 per share on an adjusted basis. But going forward into 2025, that loss of $1.50 is flipping to about a $7 earnings per share gain. And I think that speaks to inventory drawdowns, pricing power, and demand for storage solutions as well as memory. And I think that's also tied into sort of a PC as well as semiconductor cycle that we may end up seeing in the CPU markets, which are more for personal computing. We've talked about the server markets as well. That's also been moving recently. But alongside CPUs, you need memory and storage, and that's effectively what Western Digital provides. And I think that's quite compelling, considering a lot of these names that we've covered in the past month or so have forward estimates on earnings that are quite a bit higher than the current year.
All right. So with that being said, the run-up we've seen, the outperform rating, now how would you go about an example trade?
Yeah, so in this one, obviously, if you look at weekly charts, which I use, it's been in a nice upward bullish trend, and it's still going to continue, again, assuming there's not a market correction and so forth. But overall, this one seems to inch higher slowly. So what we can do is we can place a bullish trade, a trend trade in this case, with additional time, because the stock doesn't necessarily move very aggressively on a daily basis, or it's not necessarily a high beta stock. So we're going to go out to July with about 114 days to expiration, which gives us lots of time. We're going to buy an in-the-money 62.50 call option. It's a simple trend trade. And that call option would cost about $8.50 a share, or $850 a contract. So obviously the stock needs to move higher because this trade is bullish. You have essentially over 100 days for it to manifest higher to the point where a break even, if you do hold it to expiration, is $71. But ideally speaking, because what we're doing is we're buying a delta of around 70 on this option position, one doesn't necessarily need to hold it to break even or even higher. One could essentially look at closing the position or rolling the trade for a lower delta if the delta hits around 90 or so. So you could play it two ways: continuation trade, bullish with unlimited profitability, but again, break even needs to be 71. Or you could essentially look at closing the position if the delta gets close to 1.
All right, George Sillis, thank you for our disruptor today and every day, looking at Western Digital. Thanks, George Sillis. Coming up next, our 360 round, we're going to be focusing on meme stocks. Of course, you see GameStop selling off today in a big way. What else should we be watching? We'll be right back.
I remember when I first started flying, and we would experience turbulence. I would watch the flight attendants. If If they're not nervous, then I'm not going to be nervous. Financially, I'm the flight attendant in that situation. The relief that comes over people once they know they've got a guide to help them through, I definitely feel privileged to be in that position.
Download the Schwab Network app and join in on the latest market trends. Anytime, anywhere, on any device for free. Schwab Network.
Trading the trending names every day. It's Fast Market. Ready for you, ready to go. I'm Kevin Hinks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Cut the cord on the way you get market news. It's Market on Close. Join me, Oliver Rennick, for the biggest earnings coverage and insights from the smartest minds on Wall Street. Monday through Friday, 3 p.m. Eastern, available anytime, anywhere, on any device for free. Only on the Schwab Network.
No politics, no noise. From bell to bell and beyond. Available anytime, anywhere, on any device for free. Schwab Network.
Missed out on today's market headlines? Get caught up and catch the wrap at schwabnetwork.com. Available anytime, anywhere, on any device for free.
Welcome back to Trading 360. In the 360 round, we're talking all about meme stocks. Everybody remembers in 2021 when you started to see GameStop, BlackBerry, Bed Bath & Beyond on the cover of your papers, regular papers, not business newspapers, and the whole world was getting involved. And Reddit was the spiritual home of all the chat about all of this. So now what? When we see GameStop selling off today, what are we to think? Logan Gillen's with us, analyst at Joule Financial, Jim Warden, CIO, the Wealth Consulting Group. Thank you both for being with us. So, Jim, in your mind, and we see a lot of short interest, for example, and that was one of the things in my mind, they were going back and forth. Tell me a little bit, Jim, about what in your mind qualifies as a meme stock in the first place.
That's a great question. Good to be with you, Nicole. I would say whenever markets kind of have this rising tide type of environment where, there's a little bit of FOMO and people are worried about missing out, sometimes you see some frothy areas pick up. And certainly we've seen that with some of the Bitcoin ETFs and Bitcoin price itself. But other names, you can look at a MicroStrategy, super microcomputer that have just had off the charts type of performance. We tend to really look at these things quantitatively, and we want to look at free cash flows. We want to look at growth and earnings and profits. And we do look at trend, we do look at momentum, but those are not the only things that we're looking at.
I mean, there was certainly this feeling that meme stocks were not a good investment. They were considered risky because of the extreme volatility. And so, Logan, when we look at a name like GameStop, which ran up, ran down, and today obviously getting hit hard after its latest quarter, what do you think about a name like GameStop? In fact, they were talking, Wedbush was talking about the demise of this name by the end of the decade.
Yeah, I'm definitely not roaring kitty. I do not like the stock. I mean, they came out 27% below earnings estimate, so they were quite low on that. And I also just looking at the stock and evaluating it, they're not putting forward guidance. Obviously, down 15% today. It's getting hurt. I mean, I don't know necessarily if the stock's going to go away forever, but it is not a company we like here. And they don't have debt, which is a nice part of their balance sheet, but the overall earnings projection, they definitely look like they're in a bear market trend and kind of continuing down, along with the other meme stocks from 2021 that really have been kind of down to pre-pandemic levels, if not lower. So your AMCs, your Nikola, the Bed Bath & Beyond, all these different ones that have kind of gone crazy and come all the way back down. So it's not something that we're playing in those meme stocks necessarily, but I loved what the other guest said about kind of the FOMO in the different areas. And I think we're going to get a new area, and AI is going to be one of those that's going to have some FOMO and going to have some fervor that happens in this bull market that we're currently in.
All right. And then when we think about some of the names that have been meme stocks but then came back to earth, when you think about trading the names now, currently, we have a name like GameStop, Jim. What else are you watching? I mean, there is still a FOMO environment right now. There are still people with money on the sidelines that say, hey, look, 2024 looks like maybe I should put some money to work. What do you tell them?
I tell them that they need to be diversified. They need to not just look at trend and momentum. I've been looking at trend and momentum along with quality and value and low volatility. These are factors that go back decades, and they've been proven to work. They don't always work at the same time, and sometimes there's droughts that they don't work. But you know, that's what we do, and so I think when you get, you know, markets like this where, you know, it feels like it's just going straight up, and you start seeing you know, trends just becoming really, really strong, we kind of have to take a step back and say, okay, what are the fundamentals? We love the technicals, and we like to see good, stable trends. But I always wonder, like, okay, if a toothpaste maker is performing just as well as a semiconductor stock, you know, that something could be a little bit out of place there. So always just looking at it, and we want to know, like, if the multiple is really, really high, we're okay with owning it if it's growing at 50% or 100%. Right. Now, obviously, we know that the growth can't stay sustainable like that, but for what's happening now, we're in the very, very early innings of this AI boom, and we may have another 12 to 18 or 24 months of very strong growth for some of these companies. And so we have to take that into mind. We also have to look at the price that we're paying. We have to look at things like free cash flows and quality. Okay. So.
Yeah, understood. And, you know, I just put in Nikola just to see, because remember all the hype about that one? It was so exciting, and it's less than $1. Rivian, when it first came out, people were, first of all, I don't give stock advice, but people would ask me at parties, you think I should get Rivian? You know, and all I say is, you know, a lot of the traders I know don't jump into IPOs. They wait and try and get some more data, historical data. I mean, I just, you know, I don't want to give advice one way or another. I don't want to be wrong, certainly, and it's not my job. That's not what I'm qualified for. So, Logan, when you look at some of these names that have come public, Reddit, the Trump DJT yesterday, which soared almost 60% in trading, it finished up about 15-16%. Do you think that these are meme stocks, maybe, or no? You have to wait and see.
Yeah, I mean, I think it's kind of a wait and see. I mean, there's definitely some news headlines, and maybe that is part of the definition of a meme stock is like, what is the news driving for retail investors? And I think DJT is obviously one of them that has had some volatility and is going to continue. And on both sides, you know, you have the short buyers, short squeeze going on one side, and people that are buying shorts on the other. So there's a lot of things that are happening on stocks, names like that. I think what we're focused on is similar to what Jim is saying is, okay, the semiconductor space and AI might be a proxy for what the rest of the market is doing, where you have a market that has had a couple of really big companies, NVIDIA, AMD, that have done really, really well. But some of the things under the surface, like your small cap companies, have not done as well. So maybe not touching some of these Truth Socials or some of the names out there that are really meme stocks, but finding the small cap areas in a place that's worked like AI that also has value. So I'm talking about a company like AI, the ticker, not just AI, or an AMCR that is a small cap company that has value underlying, but is in a space that could have momentum and movement moving forward.
Yeah, I see in your notes, you said you like C3 AI, and you just mentioned the other one, AMCR. Thank you both so much. It's been great to see you both here. As we see DJT today at 67.64, up another 16%. It's a wild ride, guys. Logan Gilland, Jim Warden, thank you. Thank you, friends, for being with me here on Trading 360. Download our free Schwab Network app in the Apple App Store. 24/7, it's available to you. I'm Nicole Petalides. I'll see you at 2 o'clock for the watch list. Keep it right here. Fast Market is next.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 5 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with no monthly service fees or account minimums. Unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
It's time to look forward.
Find the next trend.
From every click to every tick.
There's no fear of missing out on next-gen investing.
Available anytime, anywhere, on any device for free. Empower your portfolio with the Schwab Network. He's Alex Coffey. I'm Jenny Horn. Join us for Next Gen Investing.
1 p.m. Eastern, only on the Schwab Network.
Welcome to Schwab Network.
Daily live exclusive content tailored to today's investors.
Broadcasting 24/7 from our studios in Chicago.
And from the heart of Wall Street at the New York Stock Exchange.
Up-to-the-minute market insights.
Example trades and stock-specific analysis featuring the smartest minds in the business.
No politics.
No noise.
Analysis ahead of the biggest events for the economy.
From bell to bell and beyond.
Watch live
and on demand.
24/7, 7 days a week on schwabnetwork.com.
And on all your favorite streaming services.
Available anytime, anywhere.
On any device for free.
Schwab Network, empowering every investor and trader.
Every market day.
Binge watch the market with Schwab Network. Tune in 24 hours a day, 7 days a week on schwabnetwork.com and on all of your favorite streaming services. Schwab Network, available anytime, anywhere, on any device for free. Schwab Network.
Well, good afternoon, traders, and welcome to Fast Market here on the Schwab Network. I'm Tom White. We got a great lineup for you today, including discussions and option strategies in a retail sector. We'll cover Amazon, which has rallied about 17% so far this year and is near 2-year highs, and Lowe's, which has pulled back about 2% this week and was downgraded this morning. And like Folio, will break down consumer sentiment data on Home Depot. The home improvement retailer stock is up about 37% over the last 12 months. And is also near over 2-year highs. Now let's take a look at the 4 major indices. We're kind of mixed here. We're off of the session highs that we saw early in the morning. This seems to be the trend this week. S&P 500 up 0.2%. The Dow Industrials up over 200 points. NASDAQ down at nearly 0.2%. And leading to the upside is those small caps. The Russell 2000 up 1.2% on the day. To help me break down this market action, I'll bring in my co-host, Kevin Hinks. Kevin, when you look at the market action today, one thing that stuck out to me, Magnificent Seven, most of them are down, except for Apple and Tesla. Those are the weakest two of the Magnificent Seven. now we're seeing sort of this rotation out of the NVIDIAs and the Microsofts into these names that have been underperforming.
A Magnificent Seven pairs trade.
Yeah, yes.
Well, early this morning, Morning Trade Live, Oliver Rennick started our discussion off with, what are you looking at? I said, failed rallies. That's what I'm looking at.
We talked about that on the Future Show today.
Yes.
The Russell 2000, S&P 500, the last 3 days, you start off strong, fade into the close.
And if you're bullish this market right now, you don't want up openings and failed rallies. That is not planting the sentiment of a bullish tone on this market. It opens up, closes down. Yet yesterday it was extremely weak at the end of the day.
Right.
What happens? Kind of a knee-jerk rally to start the day and another failed rally. So now 3 of the 4 indices are still up, but they're not up where they were, and the NASDAQ is down. And as you know, the NASDAQ has been quite influential in today's stock market. So it's certainly worth watching. But Tesla's firm, Apple's up significantly, and things are interesting here. But failed rallies is what people should be watching.
Yeah, I mentioned that to Ben Lichtenstein this morning on the Future Show. I go, this isn't good for market sentiment when you start seeing failed rallies towards the end of the day.
You'd rather have it go the other way. You'd rather have it open down and rally.
And strength into the close.
Much healthier.
Yep. But then again, S&P 500 still less than 1% below its all-time high. So even though we've had some weakness over the last 3 days in the benchmark S&P 500, it's still right near all-time highs. But one of the big names that we just mentioned that's actually positive today, up over 1%, is Apple. Let's bring in Jenny Horn, markets correspondent here. Jenny, help us figure this one out, because headlines for Apple have been negative. We've talked about this stock repeatedly over the last couple of weeks. Negative headlines, but at the same time, it's basically flat on the week. It's making some inroads the last couple of days.
And as we've seen from Apple as of late, now continuing to be the inverse of the S&P 500 as shares have held on to 1.5% gain today. So it's amazing to me the way that actually we've been able to perform across the 4 major indices, even without Apple's strength at all. I think that's been somewhat of a phenomenon this year, as NVIDIA has become the new Apple as far as the proxy to the S&Ps. But news we got wasn't positive, to your point, Tom, is that the China market in terms of iPhone sales continues to contract. We saw iPhone shipments decline about 33% year over year in the month of February, and about 56% month to month, to track at around 2.4 million units in the month. But the decline in February does put now their year-to-date decline in iPhone units at around 37% year over year in China. Now, JP Morgan did point to this data in the broader market in relation to the sell-in volumes and the overall higher inventory in the channel, and said that, well, the analysis of data limits concerns around iPhone share relative to domestic players like Huawei. It does raise concerns about the sustainability of the sequential recovery for the China market that was evidenced through 2023 per this analyst at JP Morgan. They maintain an overweight rating on Apple, but I thought that was interesting. They actually don't see iPhones losing as much market share as perhaps we would have thought. It's just overall weakness in that space. But there is a lot of thinking that the story with Apple and China right now, it's not so much about Apple and China as it is the U.S. and China. We have this ongoing back and forth between geopolitical tensions, the chip trade right now, as well as the fact that China's not happy about the U.S. potentially banning TikTok. So all this being said, there's a lot of the analysts that are digesting the news today that says overall geopolitical tensions need to ease, and then the story for Apple improves. I think this is a little bit more concerning, though, than some of the news we talked about with the DOJ and this antitrust out of the EU, because 22% of their sales roughly is derived from China, and we know that over 50% of the Apple sales is the iPhone. So this is more of a story where I could understand actually the pressure, and go figure, to my own analysis, we're up today. So I don't really understand it at all. We continue to see one of their most lucrative markets falling behind, and that to me definitely matters for big picture here.
Jenny, this is bad timing, because a day and a half of trading, and then we go into the Easter holiday. I don't care that much yet about this. I'm losing interest in not only these slow markets, but in Apple in particular. But Jenny, Tom just made a statement to start the show that they're selling the high-flying Magnificent Sevens and buying Tesla and Apple, which are the underperforming Magnificent Sevens. Is it as simple as that?
You know, I saw a note that actually highlighted exactly that. The underappreciated of the Mag 7 now are coming back into light. I mean, possibly Tesla has also its own slew of headlines as always, and it seems like we are able to shake those off pretty easily. I think also Apple's chart, to give it credit, looks a lot better on a year-to-date basis than Tesla's does. I mean, we're only down 10.5% this year, which is a bit better than what we're seeing from Tesla, which is down at this point now almost 28% on the year. But I do think there is the thinking that we've seen this cycle run through. We've seen these bottoms, we've seen this weakness, and somehow both of these companies are able to claw back. So I'm on board for that optimism. I just don't know if the iPhone story, especially in China, is one we're done talking about yet. I think that's going to be a continual headache.
Yeah, that's still 20% of their revenue. And Tim Cook just made that trip over there. He's saying they're coming out with the VR headset over there. So we'll have to wait and see. But I think it's a positive sign, the fact that even with the most of the Magnificent Seven down, that the market's not down that much. So rotation into small caps, some of the Dow blue chip names.
Here's the problem.
Yeah.
With the market at or near all-time highs, if the market corrects, are they going to buy Apple, sell the market? Probably not.
They might. I mean, Apple most likely would get dragged down with the overall market.
It'd have to. It's still the largest weighted stock in the S&P. It'd have to, right?
Yeah, possibly. We'll wait and see. Thanks to Jenny Horn, markets correspondent here, breaking down Apple for us. But now let's bring in Nick Theodorakis, Managing Director of Market Risk at Charles Schwab. Nick, I wanted to get your take here. As I just kind of mentioned, we've had some weakness so far this week in the S&P 500 down 3 days in a row, but it's still less than 1% off its all-time highs. Is this probably what the market needed after the rally since the October lows? Is that people aren't getting out of the market; they're just kind of rotating at this point.
This is not exactly the meaningful pullback I think we spoke about last week, guys. This is, just a little calm here, which I think is healthy. Right? I mean, you can't just have straight line rally with no entry point for anybody. So I think you have to see these pullbacks, and I think personally it's very healthy to see the selling a little bit or pause in these big names and some different sectors carrying some of the weight here. And I think with oil trending back lower, you think market kind of dispersion, you get some different names in play. Some of those sort of energy benefits we got to the inflationary story went away a little bit last month, but have calmed a bit here. I think it's a pretty nice setup right now for the broader market, and you want to see more participation, right? I think we've talked about this a lot from a risk standpoint, where such a top-heavy market is just a dangerous thing, and I think having that sort of unwind a little bit, just a tad, not a ton, right? Just a little bit, and seeing that dispersion is a great thing.
To that point, up for the quarter. I mean, quarter ends tomorrow on the holiday shortened week, Kevin. This month, all the markets are up pretty significantly. So the rally's been broad-based, but I wanted to kind of hit on the Russell 2000, which is making some ground today. Still, that 2100 level for the Russell 2000 has not cracked that level in over a year, and it seems to be a little bit of resistance at this point.
This is not one sector either of the Russell dominating. This is broad rally in the Russell today. There is green across the board in the Russell 2000. Now, I think a lot of it has to do with banks and financials. A big portion of the Russell 2000. You see that in the banks and financials in the S&P 500. They've had a great quarter. Why? I think it's because stable interest rates. Bankers, some like low, some like high, but they all like stable interest rates, that they can do their business and not have to worry about volatility. I think that's really helping a lot of these financials. So then you look at, this is a large sample size for U.S. domestic stocks, and the strength there today, pretty impressive, actually.
Yeah, I think that's a good point, Nick, because I was looking at the S&P 500 financial sector within the major index. It's just off all-time highs that it hit a few days ago. And is that more of a reflection, not of their business, but almost maybe the wealth effect with the stock markets at or near all-time highs, that the financials are doing well in an environment where, hey, loan growth isn't there. Maybe their balance sheets are a lot better. Is that a good reflection, maybe, of the economic environment we're in?
I think so. The wealth effect is absolutely real. Even in sort of the checking and savings applications, right? There's higher yielding products now, so people are seeing their balances grow, and rates are still high relative to rates are outpacing inflation at this point, I guess is the right way to really say that. So the wealth effect just from a simple interest rate product is helping people outpace that inflationary story. And I don't think any of the losses that banks are reserving for, those loan loss reserves, are coming to fruition yet. So similar to the recessionary story that keeps getting kicked down the road, guys, I mean, there just haven't been losses realized by these banks in terms of loan defaults, and that helps a lot. Stable is good, right? I guess is what the summary there is. Right? When you don't hear about cracks in the banking system and interest rates are high, banks can charge more in terms of spread, and clients do well because their savings and interest earnings are outpacing inflation. That's not a terrible story. With the curve flattening, I completely agree with Kev. Flattening and relatively stable. All this banking turmoil happened in an up environment. It could happen just as easily in a down environment, but it's really the rate of change that causes turmoil. And with stability comes the ability for them to position in kind of the medium term and make money doing it.
Yeah, Kev, I was looking at some of the sectors within the S&P 500. I mentioned the financials already, but we're getting led by utilities and real estate right now, and that's mostly on the back of lower interest rates today. But this isn't the kind of market you want to see led by utilities and real estate.
No, that's not the dream scenario.
No.
I mean, a good, strong, map of the S&P 500 with financials participating is really good and healthy. This is a function of utilities and real estate. What do they cover? They carry debt.
Yeah.
Lower interest rates help them with their debt, so they rally when yields are lower. So, yeah, that doesn't sound like a sexy market to get involved in.
Right. And the government likes lower rates, too, especially with all the debt we have, for the government.
Don't get us started. That's a bad rabbit hole.
I didn't expand on it. We're apolitical. Hey, Nick, real quick here. I wanted to discuss the VIX hovering near that 13 level. It's kind of reflective of there's not much going on this week. It's a spring break week. Volumes aren't that high at any point. But it seems like it's really easy right now if you use the VIX product. Not easy, but it's convenient when the VIX is at 13 for hedging or protection, right?
It is, whether you're trading the VIX itself or, index options that it's priced off of, guys, this is a relatively cheap time to hedge. There's a lot of swirl out there and kind of talk about, is the VIX fit for its measure anymore? Is it a measure of fear? Is it really a measure of the volatility that's being traded? It's always been an issue, right? When the event happens, whatever it is, it happens today, right? That's how it goes. So the 30-day measure isn't always right. I do follow that VIX 1 day. It's VIX number 1D in the TOS platform, and it's really fascinatingly stable. But we just hit a 1 year low there of 6. So it doesn't correlate to the 30-day vol, and it doesn't get a ton of press. But yesterday was the lowest close and intraday low that we've seen on that. So it's pretty fascinating to watch that, and it is more indicative of that sort of 0 and 1 day trade that that we see so much of. But again, both measures are just pointing towards, whether you're using the more traditional long term, or even if you look at the NASDAQ volatility, the VXN, they're all trending lower. And I think it's a little bit of what we already talked about, right? With a flat interest rate environment, there isn't this sort of looming uncertainty. The government, regardless of what you think about the dollar value, right? The government's funded for longer. That spending plan was passed. I mean, a lot of the uncertainty has come out. Much of what's out there, right, that we're really talking about, kind of in the macro risk space, is international, right? You've got concerns with China, like Jenny mentioned Apple specifically, but just clamping down on risk there. Funding for the multiple wars going on globally. But when you look at actually a domestic kind of potential shock to the market, there's not much on the horizon that we're waiting on. So I think that's why you're seeing it really trend lower. And then obviously you have this holiday shortened week, and markets are actually closed on Friday. it's not a partial futures trading session. So when you get that actual closer, that kind of affects the volatility.
Yeah.
One thing I think, just to wrap that kind of short week, Tom, point is PCE comes out Friday morning, and there is no ability to trade that. So I think we could see some sort of intraday, intranight, if you will, volatility on Sunday evening when those futures open up.
Yeah, there might be some protective buyers tomorrow in the VIX and other stuff.
There'll be some jitters.
Yeah, going into a long weekend with.
Would you buy premium going into the long weekend? Yeah.
Well, the weekend's
On
already been.
Monday's date, I would.
The weekend's already been taken out.
The weekend's
a lot of
priced.
places.
Yeah. I always used to put my days ahead
Yeah.
on like Tuesday. All right, guys, let's take a quick break. We're going to discuss the consumer today. We're going to kick it off with Amazon. The retail and cloud stock has popped about 17% so far this year, is just near 2-year highs, trying to get back to those all-time highs of about 188. Fast Market's coming right back.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
It's time to look forward.
Find the next trend.
From every click to every tick.
There's no fear of missing out on next-gen investing.
Available anytime, anywhere, on any device for free. Empower your portfolio with the Schwab Network. He's Alex Coffey. I'm Jenny Horn. Join us for Next Gen Investing.
1 p.m. Eastern, only on the Schwab Network.
Download the Schwab Network app and join in on the latest market trends. Anytime, anywhere, on any device for free. Schwab Network.
Empower your portfolio with the Schwab Network. Schwab Network is available anytime, anywhere, on any device for free. Schwab Network.
Binge watch the market with the Schwab Network. Tune in 24 hours a day, 7 days a week on schwabnetwork.com and on all of your favorite streaming services. Schwab Network, available anytime, anywhere, on any device for free. Binge watch the market with the Schwab Network.
Welcome back to Fast Market here on the Schwab Network. We're talking retail today. We're going to kick it off with Amazon. The cloud and retail-based company has had a pretty good year, pretty good run over the last year and a half here. Kev, when you look at this, the silos of revenue generation, I always talk about this. Cloud-based business, that's their high-margin business. The retail side, now you've got advertising coming into the mix. Prime membership up over 200 million people. That's at what, $120, $130 a year. So they've got a lot of drivers here for revenue growth.
Up 17% in the last 3 months, and people think it's still cheap at these levels.
Yeah.
Now, we don't know that for sure, but if the whole market sells off, we don't know. But yeah, remember, there's been a lot of headlines about Google Cloud and Azure gaining market share on Amazon. But Amazon's still the dominant #1 player.
Over 35% of cloud, right, yeah.
And e-commerce, they dominate e-commerce. So there's plenty of things. And how about this? Operating margins from 2.34% year over year to 7.5%. Revenue, 13.9% year over year increase in revenue. These are big numbers for a company that, has trouble finding, increases like that, such massive numbers. But this company's putting up good numbers. Remember, they go through these peaks and troughs where they spend a lot of money and then they don't spend and they make a bunch of money.
Yeah.
So you got to ride the wave the right way. It looks like right now it's on a pretty good up wave here.
Yeah, you mentioned that because in 2022 they spent a lot of money.
Yes.
They put a lot of investment, and that's what they've historically done.
Yes.
They'll
You just
invest
gotta
in something.
know that.
Yep, exactly. And then the stock hit 81.43, and that was at the end of basically 2022, Nick. And it's been a straight shot to the upside here near 2-year highs. But what's your thoughts here on Amazon?
Yeah, there was another price target move this morning up to 200 with an outweight rating, and you guys sort of mentioned it at the top of the show, the Magnificent Seven. It's kind of been like the Magnificent One or Two, right? We haven't really talked a lot about it, but there's been some big movement in Amazon, and it's hard to lump them in with a retailer. You could put them in with 3 or 4 different segments, right? So they are, but I mean they're the biggest cloud provider, and they're tied to the AI story as well. So that's clearly boosted the sentiment of the stock. I think the other thing, I guess I just call it on the downside to think about here is the amount of sort of litigation that's against all of these major companies. But there's EU litigation directly. They were just fined by Poland, country of Poland, right? They were just a lawsuit was upheld in the state of Wisconsin to call drivers, employees, like they are getting just barrage from a legal standpoint everywhere. And most of these companies, and I'm kind of lumping them all together, have really withstood that pretty well. But they are, all the regulators, U.S. and abroad, are coming after these major companies, and it's kind of interesting to see, how much improvement there has been in terms of delivery speeds that Amazon's pushed the envelope on, and how much they've done from a cloud perspective to see them just getting attacked from every angle. So you have to keep a close eye on that if you're investing here, because as we've seen most recently with Apple, one headline about a lawsuit can really change the dynamic of the trade. And when they're such lofty valuations and they've come so far so fast, they can take the air out of those pretty quickly.
Yeah.
So I think that's the one point of caution. But yeah, clearly a strong business model all the way around, guys. I mean, they remade one of my favorite movies, Roadhouse, recently. So Prime Video hitting on all cylinders as far as I'm concerned, too.
I watched it.
Oh, I heard it was horrible.
I watched it. It's not horrible.
I love the first one. When it's on TNT, I'll like just sit there and watch it for an hour.
Yeah, I thought it was actually good.
Oh, you did?
I mean, how high are your expectations for it?
It's Roadhouse.
Yeah, right.
The first one was bad, but
dudes
good.
fighting. I mean, what else do you want?
Yeah. So don't read the reviews on it.
Instead of Texas, it's the Florida Keys. There
you
Change
go.
It. Punching in blood.
All right, you got an example trade for us here, Nick, with the stock up near those 2-year highs. How do you want to look at this one?
Yeah, near 2-year highs. A couple of days ago, they hit that high, Tom. I did a skewed iron condor here. There's not a ton of news. I mentioned the legal risk. I think a lot of that's out there. I mean, like I said, it's coming from every angle, so you always have to factor that in. But it certainly feels when you look at a medium-term chart, the trend is higher. So not crazy vols out there right now. Earnings aren't until early May. So I just went out to the April monthly options. So that's the 19th of April, and just did a little bit of an unbalanced condor here. So the 190.95 call spread, so 5-point wide call spread on the upside against the 167.5, 175 put spread on the downside. So just using that half strike, going an extra $2.50 wide for a $7.50 wide put spread, collecting about $2.17 in that trade. So on the upside, you're almost a 1-to-1 risk to return. So if you stay in that range, you keep that credit, it's $2.17. Your maximum loss on that's about $280. So pretty close, 1-to-1, even if you get that outsized move. On the downside is where the larger risk comes in, and because that $7.50 wide spread, you're only taking in the 2. You've got just over $5 in risk to the downside. So it is neutral, but where I selected these strikes, we're trading right around that 178 area, so a little bit more room to the upside, a tighter range on the downside, and a wider spread there. So there is a bullish bias to this, but an overall neutral strategy with a decent range. It would be that 192-ish break even on the upside. So you've got quite a bit of room for it to run and hit a new high. 172 on the downside, so a tighter break-even point on the downside. But again, neutral, leaning a little bit bullish over the next month and a half.
Yeah, it's hard to fight that upward trend on these stocks, even though maybe some consolidation warranted at this point. Let's break this one down. April 19th, so 23 days to expiration. Selling a call vertical that's on the upside, sell the 190 call, buy the 195. On the put side, sell the 175 put, buy the 167.5 strike put, collecting roughly about nearly $2.20. You see those break evens on the screen there, 172.83 on the downside, 192.17 on the upside. Kev, he mentioned the fact that the risk is to the downside,
Sure.
$532 roughly on the downside, and that's below 167.5. But Kev, this is, as Nick mentioned, it's a neutral strategy, but gives you a little bit more comfort zone to the upside.
It's a neutral strategy by definition. That said, it's got a 11 delta.
Right.
So, it's two things. That put vertical is closer to at the money, right? That gives you delta. And it's wider. That gives you delta. So it is, by definition, a neutral, a range-bound strategy. But you'd rather have the stock go up than down. Let's put it that way.
Yep, and you still be comfortable because that break even at 192.17. That's basically the short 190 strike, about 84% probability of finishing out of the money, high probability of success. The short 175 put on the downside, that's only about a 65% probability of finishing out of the money on the downside.
So it gives you that delta.
Yeah, so we always talk about iron condors being neutral, but you can see right here the way that you develop this strategy by widening out maybe one leg of it, you can actually create a bias to this trade while it's still relatively neutral, but definitely looking for some consolidation, maybe a slight grind higher here. And that short 190 strike would be above the all-time high, which is 188 from a couple years ago. All right. Thanks to Nick Theodorakis, Managing Director, Market Risk at Charles Schwab, for joining us. But coming up after the break, Kevin and I are going to be joined by Landon Swan from Likefolio for a discussion on Home Depot and the sentiment data on the stock moves. The home improvement retailer has seen its stock jump about 37% over the last 12 months. And the upcoming quarter is historically its strongest. Stick around. Fast Market's coming right back.
Ameritrade is now part of Schwab, bringing you an elevated experience tailor-made for trader minds. Go deeper with Thinkorswim, our award-winning trading platforms. Unlock support from the Schwab Trade Desk, our team of passionate traders who live and breathe trading. And sharpen your skills with immersive online education, crafted just for traders. All so you can trade brilliantly.
Binge watch the market with the Scrob Network. Tune in 24 hours a day, 7 days a week at schwabnetwork.com and on all your favorite streaming services. Scrob Network, available anytime, anywhere, on any device for free. Scrob Network.
Spotlight the biggest market trends on Trading 360. 11 a.m. Eastern, only on Scrob Network.
Kickstart your morning with a full dose of commodities, technical analysis, economic data, and anytime, anywhere, on any device for free. And available on all of your favorite streaming services. Futures with Ben Lichtenstein every weekday, 8 a.m. Eastern on the Schwab Network.